Good morning. This is the 14th meeting of the Joint Select Committee on Finance and Legal Affairs. The committee is convening its second public hearing on the issue of commercial banking fees in Trinidad and Tobago. For those of you who are following us live, either on TV or on the radio, the first session had been held on Friday, February 17th, 2017, when we had personnel from the central bank here. This hearing is being broadcast live on the Parliament channel, Parliament Radio 105.5 FM, and Parliament's YouTube channel, ParlView. Members of the viewing and listening audience are invited to send comments or questions via email at parl101@ttparliament.org, parl101@ttparliament.org, or on our Facebook page at facebook.com/ttparliament, or on Twitter @ttparliament. Now, having got all of that out of the way, which I have to say because we are live, I'd like to welcome members of the Bankers Association of Trinidad and Tobago. Thank you all for being here and for being here on time. I apologize for our late start. I will ask Ms. Schnorr, the chairman of the association, to make some opening comments.
Thank you, Madam Chairperson, and other members of the committee and the Secretariat of the Joint Select Committee. Let me first start by thanking you for the opportunity to answer questions on behalf of the Bankers Association of Trinidad and Tobago. We are aware that the topic of fees and charges in the banking sector has been the subject of much public debate, and we look forward to the opportunity to speak to this committee, and probably more importantly to the people of Trinidad and Tobago, to clarify some misconceptions which may have made their way into the public domain. I would first like to start by explaining the role of the Bankers Association, which we are representing here today, and of course to discuss its core purpose. BATT is an association which comprises all 8 of the commercial banks in Trinidad and Tobago. Its core purpose is to ensure that member banks are positioned to meet international trends and compliance standards, educate the public on financial options available to them, public awareness of fraud and risk prevention, as well as working with the central bank and other regulators on areas to improve the overall strength and stability of the sector. That's it. As an association, we are not involved in the internal business decisions of any of our individual members. Let me move on to the next page. As we look at the purpose of this inquiry, I think it's important that we first reiterate the overall role and the importance of banks to the economy of any country, and to understand how each of our members contribute to the economic development of the country. Banks play an intermediary role by channeling funds from depositors to borrowers, thereby increasing economic efficiency. Indeed, when we look at the GDP of Trinidad and Tobago, financial services is perhaps the second largest contributor to the GDP of the country, and consequently provides significant tax revenues. The health of the financial sector is therefore critical, and each of our key stakeholders in the sector, and here I refer to our shareholders, our depositors, and our regulators, all of whom have a keen interest in our continued growth and stability. Our depositors in particular want to be assured that their deposits are safe. Our shareholders, who in large measure are citizens of Trinidad and Tobago, want a return on their investment. And our regulators want to be assured that banks are well managed and adequately capitalized to meet any unforeseen shocks which may impact the viability of the industry. These are some of the key reasons the financial industry and commercial banks in particular are so heavily regulated. So that gives you some context and background as we turn to the particular subject of this inquiry and to set the stage for some of the questions I'm sure members will have today. I would like to note that in preparation for this inquiry, and because BATT does not collate or have knowledge of the strategic making process of any individual member bank, we engage the services of an international accounting firm to collate information in aggregate on the industry. Here are some of the facts which came out of that engagement, which I think the public will be interested in. Fees have not increased annually for any fee category analyzed over the last 10 years. Fees and service charges were adjusted only 3 times over the last 10 years and independently of each bank. For some fee categories, there were no increases over the past 10 years. Online and mobile options have remained free over the last 10 years. For many fee categories, the inflation-adjusted fee increases have actually been negative over the last 10 years. When compared to similar services provided by banks in the region, in almost all fee categories in Trinidad and Tobago were lower than our regional counterparts. The overall conclusion of this review is there is no price collusion among banks in setting fees and charges, and bank fees and charges are determined by individual pricing considerations which include operating costs, competitive product placement, influencing customer behavior, alternate channels available, and investment in technology. Here are some other pertinent facts. Fees and charges represent 7 to 11% of the total revenue of banks. The banking sector's profitability per customer and per account has declined over the last 10 years, and there are many reasons for this, the primary being the tremendous increases in operating costs in all banks over the same period. Net interest margins in the banking industry are at their lowest level in over a decade. In all major loan categories, interest rates today are lower than they were a decade ago. Deposit rates have also declined during the last decade, and this is related to the buildup of liquidity in the sector. As a reference point, deposits have grown from 50 billion a decade ago to over 110 billion today. Profitability in the banking industry has marginally moved at a compounded annual growth rate of just 1.2% over the last decade, and declines in key measures such as return on assets and return on equities are noted for most banks. So what does all of this mean for the public? Banks are not price fixing, and fees and charges are reflective of the cost for providing these services. In addition to the 8 commercial banks, there are a number of other entities which provide financial services, and here I speak to the 126 credit unions in Trinidad, the insurance companies, and of course the Unit Trust Corporation. And therefore competition is fierce among all players, not just commercial banks, which in large measure has kept fees at a relatively competitive levels, even when compared to other regional banks. Over the past decade, the commercial banks have provided over $4.6 billion in taxes to the government and over $11.8 billion in dividends to shareholders, the vast majority of whom are residents of Trinidad and Tobago. Banks play a critical role in the economic development, and a vibrant commercial banking sector is critical to the future growth and the stability of the economy. Banks have invested heavily in technology over the past decade to provide new products and services to customers, which make it easier and cheaper for them to conduct their banking needs. I wish to conclude these opening remarks by stating that banks are proud to provide the services we offer the public, our customers. Many of our members have been doing so in Trinidad and Tobago for over a century. Our entire value proposition and core purpose is to provide our customers with financial advice and options to suit their individual needs. Banks also play a critical role in the communities we serve. We employ over 7,400 citizens, and during the past 3 years alone, we have contributed $131 million to the various corporate social responsibility programs that we each individually undertake. Indeed, despite the tremendous challenges facing our country, banks collectively have increased spending on CSR by 20% over the last 3 years alone. We recognize and embrace our role in society, and we look forward to continuing to work with our customers to grow and develop this beautiful Twin Island state. So thank you very much, and we'll now answer any questions the committee members may have. Thank you.
Thank you, Ms. Schnoor. Before we go on to the questions, I want to say I appreciate the fact that you took the time to go through your content slowly so that our viewers would be fully apprised of the position of the association before we start. Now, I am not sure as to whether the persons who are attending today on your part are the same as on the last occasion. So what I'm going to do is to simply from left to right ask you to introduce yourselves.
Morning, everyone. I'm Lindy Balatel. I'm part of BATT Legal Committee.
Good morning. I'm Karen DeBasey, the Group CEO at First Citizens and the Treasurer of BATT.
Good morning, Nigel Batiste. I am the Managing Director of Republic Bank Limited and the Vice President of BATT.
Good morning. I'm Kimmy Rochard. I chair the BATT Legal Subcommittee.
Good morning. I'm Kelly Butts-Heaton and the Executive Director of the Bankers Association.
Good morning. Rachel Lakis, BATT Legal Committee and Counsel for Scotiabank.
Thank you all. And now I'll ask members of our committee, starting with my Vice Chairman, to introduce themselves to you.
Michael Coppin, member.
Prakash Ramadan, member.
Wayne Sturge, member. Lawrence Rambarat, member.
And my name is Sophia Choate, and I'm the chairman of this committee. And the gentleman to my left is Mr. Julian Ogilvie, whom you may have communicated with in the past with respect to the setting up of this inquiry. The other persons you see in the room are members of the Secretariat and members of the audiovisual team. Now, for the viewing public, I need to remind everyone about the 6 objectives of the inquiry. I'll do so very quickly. 1, to determine the rationale for the fee structure observed by commercial banks in Trinidad and Tobago. 2, to determine the feasibility of state involvement in the regulation of commercial banking fees in Trinidad and Tobago. 3, to determine the possible effects of unregulated fees on consumer welfare. 4, to examine the possible instances of anti-competitive behaviors by commercial banks with respect to fees. 5, to ascertain the amount of profits made by commercial banks per year due to changes in fees over the last 10 years. And 6, to ascertain the trends in banking fees or charges in Trinidad and Tobago in the last 10 years. Now, because we are short for time, and because Ms. Schnoor has been so thorough in her opening remarks, I think that we can go straight to questions. And I invite any members of the committee who would like to start off. Mr. Ramada.
Oh, first of all, let me tell you how grateful I am for your opening statement. And it really doesn't add much to say that banks are crucially important in our society. But what I find very disturbing now, and for whatever reason I think we need to explore, there's a tremendous backlash against the banks. We need to know how we've arrived there, if there's good reason for it, or whether it's unreasonable. And one of the issues that have come to us as members of Parliament is the number, and some have described it as incredible rise in banking fees. I've heard you say that there's been no real increase over the years, over the last 10 years. So we need to explore something in relation to that. And I would like really for you to also explain to us, in a declining economy for the last couple of years in particular, we've seen banks posting record profits. And at the same time, we are getting disturbing reports that when persons go to the banks for any loan, that they are met with a collateral requirement that sometimes exceed the value of the loan required. And many stumbling blocks are put in their way for the citizens to have access to meaningful funding to create business in an economy that requires it. And we'll explore some of that, but I would like you to give us some response to begin with on that.
Thank you for your question. And yes, we represent 7,400 employees across an industry. So obviously, we are concerned with any negative perceptions of any of our members. And it's very important that we address some of the concerns that have been expressed by various customers. And I think it's important that we understand the different ways in which people interact with banks. There is the impression sometimes that there is one product for all customers. And it really is around how do you choose to interact with the bank. I think we have invested quite a bit over the last decade and for a number of decades in trying to provide new and different options for clients. So if you want to interact with the bank to save, there is a suite of products that are geared towards that particular activity. If you want to interact with the bank to do a number of transactions, there's a different suite of products to suit that particular activity. If you want to interact with the banks only online and through mobile channels, there is a suite of products that suit that. So I think for us, and what we have learned through the last few years, is that it's very important for clients to have access to information, to make the choices that suit their particular need. And that's one of the reasons we have partnered with the central bank to ensure that all our services are now public, not only on our own individual websites, but also on the central bank's website, so that clients are better informed to choose the particular service that suits their need. And that's one of the reasons why we think education and financial literacy and providing information to clients is so critical. In terms of the decline in the economy and banks making record profits, I'll ask my member here to talk a little bit more about, the profitability in line with the sheer size of the banking industry? And what happens to those profits?
So let me start by saying, I'm going to address this from three sides. The first thing is, and in a very topical manner, rating agencies and entities that look at banks. And when entities outside, such as the rating agencies, look at banks, they look to banks from two very fundamental points for strength. One is profitability and one is capital. And those are two things that the banks have very closely monitored to ensure that we maintain a strong banking sector in Trinidad and Tobago. We've all seen the impacts in the global economy of difficulties within a banking sector and that impact on the economy as a whole. When you look at the profits that banks are making, I'd like to start, before I go into Anya's specific question, and understand how profits are deployed, for want of a better description, because I think there is a perception that the profits are for some purpose held by banks. So when you look at profit, and I start by profit before tax, so base profit, which is revenues less operating expenses. The first thing that comes out as a payment from profits are taxes. And as Anya mentioned, banks, as a significant contributor to GDP, have made over $4.6 billion in tax payments to the government of Trinidad and Tobago over the last 10 years. Taxes go towards the better interest of the general public. They are paid across to the government for deployment of the better interest of the communities at large. The second point that comes out of profits are dividend payments. And again, dividend payments go to our shareholders, and the majority of the shareholders of the institutions, certainly around this table, sit in Trinidad and Tobago. They are individuals and they are institutions, and I think if you look very specifically at the dividend payment track record of the banks, most of the banks make dividend payments in a 45 to 55% range. So after taxes, the next point of profits go into dividend payments, again out into the general public, benefiting shareholders, institutional investors, members of the public.
Mrs. Darbesi, I don't want to interrupt you, but since you referred to shareholders, I would be grateful if you could confirm this, because we got this information from the annual report for FCB for 2016. The majority shareholders for First Citizens Bank are First Citizens Holdings Limited, National Insurance Board of Trinidad and Tobago, Trinidad and Tobago Unit Trust Corporation, stroke FUS, whatever that means, Guardian Life of the Caribbean Limited, Republic Bank Limited, National Enterprises Limited, RBTT Trust Limited, Tatil Life Assurance Limited, Colonial Life Insurance Company Trinidad Limited, and RBC Trust Trinidad and Tobago Limited. So your majority shareholders are other banks and insurance companies, is that correct?
We have in excess of 12,000 shareholders. Those would be the majority shareholders.
Yes,
but
I'm asking about the majority shareholders.
The majority shareholders, First Citizens Holdings Limited, is owned by the government of Trinidad and Tobago.
Yes.
Yes.
And the other majority shareholders, or the other shareholders which may be included in the description of majority shareholders, are other banks and insurance companies?
Yes, but I think you need to dimension what that means. So it's banks in the form of trust companies, which are the pension fund investments.
Yes.
And it's the unit trust, which is the mutual fund holder on behalf of investors, which are the general public. So they're not banks. Republic Bank Limited doesn't own shares in First Citizens for its own right. It is Republic Trust or RBC Trust who's holding it on behalf of pension funds that they're managing. But yes.
And this is why I asked the question, because someone reading the annual report may not necessarily know that.
Draw that connection.
So I thank you for your explanation.
So it's not for their own individual capacity, it's on behalf of further funds that they are managing.
Yes.
Okay. And the third point on the profitability, so I've dealt with profits, and the first thing that comes out are taxes across to the government. The second point are dividend payments across to shareholders. And the third point is going back into the retained earnings or the capital of the bank. And I said at the beginning that bank strengths are measured in large part by its capital. And what is capital? Capital is the fund that the bank builds up for future investments, but also for buffers for adverse economic conditions. So the profits of the banks are deployed, as you can see, for better interest of several stakeholders. That's the first point. As part of the analysis that we retained the international accounting firm to do, you don't look at profits in isolation. You look at profitability as a measure against several factors. One of the measures that the accounting firm look at is profitability as a return on assets, which really link your profit to size.
Now, Mrs. Dabesi, we have to make sure that the information that we put out is understood and accepted. So if we have too much information or one speaker giving too much information at a time using terms which are normally confined to the financial industry, we are going to lose the impact that we want to have as a result of this inquiry.
Understood.
All right?
But can I just interject? You said that the banking sector's paid $4.6 billion in taxes over 10 years, but that's spread across 8 commercial banks over 10 years. That's not much.
4.6 billion is
over 8 commercial banks over 10 years. That's not much per year.
I'm not sure I would consider 4.6 billion over 10 years as 460 million per year as not material.
Per bank. And per bank it would be what?
Tax, whatever the corporate tax rate.
Whatever the corporate tax rate.
Right, but
it's just gone up to 30%.
This is against the background that in the last 10 years, have you made losses? You all seem to be profitable and post billion-dollar profits every year.
So let's look at what does that mean. So you have an industry today that's the asset size is $130 billion. So when you look at the size of the commercial banking system, it's a second largest contributor to GDP in the country. So what you're looking at is an industry that's pretty big.
Right.
So therefore, it goes to say that the profitability of that industry based on its size would be bigger than a smaller company in a smaller industry.
Yes, but
so,
the short
you
point
have
is,
to compare it to its size. Compare it to its size.
I understand all that, but what I'm saying, in the context of the economy sometimes doing well and sometimes not doing well, and sometimes in entrenched recessionary periods, you seem to be making profits every year. So I'm wondering, in light of what the material you've given us, I'm wondering if you all have any risk at all.
If we have, sorry?
What sort of risk you all have? I mean, taken into the context, what Mr. Ramada has put forward, and I know to be a fact, sometimes you seem not to take risk in terms of giving loans because you're asking people to have their loans fully secured by collateral. In fact, in many instances, they are being asked to put, if they want to borrow $3,000, to put $3,000 in the bank. So what risk is there for you?
Good morning again, members. I would just like to build a bit on what Karen and Anya would have said, and also to address specifically that question about the collateral requirements and the risks to the bank and the loans. But I actually will start from that second part of the question, which is the risk to the bank and the loans. Over the last 5 years, loans in the commercial banking system have grown on average cumulatively by over 6%. If we look at a breakdown of those loans, mortgage loans have grown on average per annum by over 8%. So there's a substantial amount of individuals who have been able to access loans from the banking system over the last 5 years and even before that. And when we talk about the collateral requirements for those loans, Karen made reference to the fact that when countries are being assessed by international rating agencies, these agencies look at the profitability and the strength of the banking system. And I don't think this will be particular news, but it certainly occurred yesterday, where Standard & Poor's, in following their downgrade of Trinidad and Tobago, advised me that Republic Bank was also being downgraded in their rating. And when they put out their release and they indicate the reasons for the downgrade, there are two things that stand out. Besides the downgrade of the country, they make reference to the implications of that downgrade on the profitability and capital of the banks. And in trying to explain why they felt there was an implication, they made further reference to the fact that the house prices and other security that the banks may hold are likely to decline as a result of the downgrade in the country and let's say the economic slowdown, which could have implications for the provisioning requirements, which are the requirements that the bank would have to set aside, the capital that the bank would have to set aside for bad loans, for non-performing loans. And
can you set up an idea?
Mr. Batiste, we're trying to reach the layperson.
Yes.
So I know lawyers talk in a certain kind of jargon, and I know that bankers and financial people probably do so as well. So when you answer questions, could you try to make it as simple as possible so that we don't need to ask follow-up questions as what do you mean by that and that kind of thing? That would help us, I think, quite a bit. But the Vice Chairman has a question.
In your opening remarks, you would have categorically stated that the competition in Trinidad and Tobago amongst banks are fierce, if I remember correctly. However, in my own research, and I know as lawyers there's a rule against hearsay, and gentleman is not here, or person purporting to be the gentleman is not here, but I came upon a website by the name of JaralaRambaran.com. And if in that particular website, there's an article that deals specifically with the issue of competition. In fact, it goes in great detail in breaking down the structure of the market. And on that website, the author claims that, in fact, the four largest banks currently control over 90% of the market. He says that RBL and FCB control 70% of total loans, and RBL and FCB control 75% of total deposits, and RBL controls over 25% of the forex market. Is that an accurate representation of the structure of the financial institutions, of the banking sector in Trinidad and Tobago?
I haven't had the opportunity to read the website that you're referring to. I think in the context of the entire financial system, and I know there is a tendency to focus only on the commercial banks, but you also have to look at the wider financial market. There are 126 credit unions in Trinidad and Tobago. There are a number of insurance companies.
Ms. Schnoor, I'm sorry to interrupt you, but could we get a direct answer to what was a pretty succinct question?
In terms of the four banks controlling?
Yes.
Well, I think I'm trying to answer it in the context of the wider market.
No, I just want to know about the banking sector. That's all I want to know about.
The commercial banking sector, the four banks that you would refer to are the largest banks in the country. They have operated in the country for a number of years, and would, by their presence and their market reach, the number of branches that they have, would have a larger market share than some of the newer entrants who have entered the market within the last decade.
Well, in fact, it goes on to say that in 2000 there was a study by the Center for Latin American Monetary Studies, which was published, and it dealt with Trinidad and Tobago, and it's a well-respected international journal, and it has the article was titled "Money Affairs on Banking Competition." Money affairs. He goes on to say in detail, so he doesn't say, that it's large or small, but he says RBL, FCB, RBC, Royal Bank, and Scotiabank control 90% of the total banking sector assets. RBL and FCB, 75% of total deposits, 70% of total loans. You must have that information. I'm asking you directly, is that an accurate representation of the banking sector in Trinidad and Tobago?
As I said, the larger commercial banks would have a larger representation of the banking sector, and therefore, by virtue of that, would have a larger section of loans and deposits.
So it is not correct to say that it is fiercely competitive. In fact, that study, I think, recommended that 2 larger, medium-sized banks be allowed to enter into the country, which would allow there to be a more competitive market in Trinidad and Tobago. And he goes on to say that, in fact, JMMB and Bank of Baroda did, in fact, enter into the market, but it has not led to any significant increase in competition. That's my understanding. Is that an accurate representation of the banking sector in Trinidad and Tobago?
As I said, the competitive nature of the banks between the 8 of us, if you want to narrow it down to the 4 or 5 larger banks by size, is significant. When you add to that the other financial players who also offer similar products and services that we do, they offer mortgages, they offer short-term loans, other near deposit type products. The entire financial system is highly competitive.
So it would not be true to say that there's an oligopoly in the banking sector in Trinidad and Tobago?
I would definitely say not. There is no oligopoly, there is no control of the commercial banking sector or the financial sector by any group of institutions. We are all in the business of providing services to our customers. And the reason I know this, and the reason you can look at the other data, which shows that interest rates on mortgages are at their lowest level in 30 years, and you can see...
Excuse me.
Yeah.
I think we are falling into the same error that we fell into at the start. Too much information, too much jargon. I think, Ms. Schnorr, that you have answered the question, and the simple answer was yes. So, do we have any other questions from members?
I have several. Would it be correct to say that mortgages included, most of your loans would be secured, and those that are not, a greater percentage of your loans, whether secured or unsecured, would be insured?
Most of the loans would be secured,
Secured,
but
right?
the loans that are not secured would not be insured.
Insured.
Would not be insured.
But what percentage of your loans would be unsecured?
That is difficult to estimate, but if I look at the breakdown of the loans, I would say roughly maybe 20%, 20-25%.
20% would be unsecured.
Unsecured.
But unsecured loans, generally, you would give to businesses and so on, as opposed to the smaller man?
No.
So the larger percentage of unsecured loans would be going to who?
In all likelihood, it would be going to the smaller man.
Right. And in terms of insurance?
Credit cards are unsecured loans, so
Right.
That's a significant portion
That
of
would
the
be
unsecured loan portfolio.
but then the interest rate on credit cards would be 24% as opposed to other loans, not so?
Reflective
So that
of the
takes
risk.
care of the risk, generally.
Reflective of the risk.
Right, so generally, most of your loans are secured, and then most of your loans are insured, correct?
No. Well,
Hold on.
the unsecured.
Are you telling me that most of your loans are not insured?
So mortgage loans Are you talking about the mortgage loans being insured?
Mortgage loans, the security would be the house, for
Correct,
instance.
correct,
right?
correct.
So that if there's a default, you sell the house and
Correct.
your risk is minimized, correct?
Correct.
Okay, outside of that, car loans, for instance, you have a mortgage bill of sale on the car.
Correct.
If the person defaults, you get the car.
So those are counted
So
as
your
secured.
risk is small.
Correct.
And then there are other loans. Do you not insure a great percentage of your loans?
Okay, so once the loan falls into the unsecured category, the answer is no, it is not insured.
It is not insured. Right,
Could I interrupt and ask a question? Is it then that the unsecured loans are sort of like the on-demand loans below 30,000, that kind of thing?
Not necessarily. Not necessarily. Most of the retail loans, and that's why Karen would have included the credit card loans, most of the retail loans that we would call them, which we give when you see a loan campaign around Christmas time or any time, those tend to be unsecured loans.
And I also wanted to inquire, for the loans that you insure, does the customer have to take the cost of that?
I guess we're trying to understand when you say insure, what you mean. And perhaps you can clarify that for us.
Yeah, sure. The Vice President had indicated that loans are secured, and those loans that are not secured, you are left with two other categories, the unsecured, and you would have loans which are insured.
We don't have loans that are insured. I don't know if you're referring to people that may take out life insurance or other insurance
Well, perhaps
separately.
you could explain how insurance works in the context of loans?
For individuals, for their own personal circumstances, and that is something that each client would determine on their own, would decide whether they want to take out a life insurance policy.
Against borrowing, yes.
In the event of death, and then they would, on their own, decide if they want to assign that policy to pay off their individual loan.
Well, quite apart from that, I take loans from time to time, and sometimes I'm told if you want to insure the loan, you can pay X amount and have the loan insured. So if you default, then it's covered, and your rate of interest, if you insure the loan, would be less. But if you do not insure the loan, the rate of interest would be more. Does that not exist?
So there are various structures.
Is that yes or no? Does that not exist?
That option exists.
Yes. So then there are facilities for the banks to insure and therefore further reduce risk.
There are facilities for the client to insure and therefore reduce the risk that should something occur, right, that you might actually have to fall back on either the property or some other asset that the client may have.
Right, but the person,
that's the main reason for the insurance,
the
really.
person paying to give you some sort of breathing space so that you are not all worried about risk is the client himself.
Yes, but I do think we need to understand that they're really paying to give themselves and their families the breathing space, because it is an option. And so you would find that, and it primarily occurs with the mortgage loans, that individuals will be advised that insurance would be good. Because if you take the insurance and should something occur, then there will actually be no need for the bank to rely on the property.
Yes.
Sorry.
My mic will not work if there are 4 mics on. So for the listening public, basically, if you are taking a mortgage, the mortgage is taken on the property, the house that is being bought. Let's say you have a young couple now married, buying their first home kind of thing. And they are asked by the bank to take out life insurance policies, and the purpose of that is if anything happens to one, the other one, especially if the other one is not working outside of the home, the other one will not lose the security of the home. Is that correct? Now, I also want you to answer as well. whether this is an option or whether the loan will be refused if such insurance is not taken out.
I think it depends on the particular individual, on their longevity of their work history, on their cash flows, on their, trying to simplify it. So you look at their expenses and their income and the potential, the possibility that the income, if you lose one job from the household, its ability to service the obligation. So it's not a yes or no answer, it's an evaluation of each credit situation, of each applicant's situation.
Thank you very much, Chair. Now, while we're on the issue of home mortgages, we do know this issue of the property tax looms very large. How will the bank prepare itself where under that law there's a preeminence of the state over mortgages that you have already, whatever insured or whatever, there's a preeminence to the state to override your rights?
You repeat the first part, which law?
Under the Property Act.
Property tax.
Yeah, Property Tax Act. That there is a preeminence if the property tax, quote unquote, is not paid for a period of time. Whatever mortgages or whatever you may have on your insurances and so on. How would you prepare yourself where the state now has preeminence over your right of redemption?
When we look at, when a customer comes into a bank to apply for a loan, we look at their income and their expenses. And that would include property tax. So we look at what they earn and what they have, what their obligations are in a given year to see can they qualify for the loan. And that's where we take it into consideration. So it would be upfront at the application.
I appreciate what you're saying in terms of moving into the future. I'm speaking about the pre-existing mortgages. How do you deal with this?
But sorry, maybe I can answer, because I think the condition that exists in the property tax legislation, and I'm not a lawyer by any means, was one that always existed where the state had preeminence if taxes weren't paid. So that's not a new condition as far as banks' assessment of the collateral risk is concerned, if that's the question.
But certainly there would be a dramatic rise in the cost to the homeowner from what would have been historic numbers, $70 or $100, now it'll go into thousands. So that your numbers would be affected. So would you then be taking into consideration now those issues to revisit pre-existing mortgages? And then I'm also hearing you saying this, and just a yes or no, that going into the future, that will be an important component in the determination of the viability of the mortgage.
It would be a component of our credit decision making, and that is something that has always been there. It's nothing new. It was always there.
I'm happy to hear you say it's nothing new, but we're dealing with banks and its viability and those who would then be able to access mortgages as we go into the future. You do agree that the numbers of the past are completely different from the prospective new numbers. Thousands of % increase in property tax, if I may use that term loosely. Do you agree with that?
As we said, each application is going to be evaluated based on the valuability of what the customer earns, what the customer's expenses are, and we'll take it into account. I'm not aware of the particular percentage increases. I think that is that when it's finally evaluated per customer and what it turns out to be for new applications. But going back in time, we'll not be revisiting any mortgage applications that we gave in the past.
Well, the short point is, I think, in response to Mr. Ramadar's question, is that it may affect the ability of some people to access mortgages. I believe we have a question from Minister Ambarat.
Thank you. Thank you very much. I just want to focus on the 5 objectives and on inquiry 1. I don't know if you followed, but in February when we had the governor of the central bank report, I asked some questions, and I'm going to flow along those lines. The first is, the inquiry requires us to consider, or to ask you about the rationale for your commercial banking fees. my assessment, based on your presentation, is that there are three areas in which I could say that there might be a rationale. First, cost recovery. Second, and that's for another discussion, disincentivizing, because I recognize that you feel you need to disincentivize the walk-in customers so that people could migrate to other forms of banking, particularly mobile banking. But the third area is the area of income generation, and you say on page 16 that over the last 10 years, bank fees have contributed somewhere between 7 and 11% of income. And the question I asked the governor of the central bank was the extent to which banking fees represent cost recovery and the extent to which they represent an income stream. That's the first question. And then the second question deals with following along what some of the previous persons have asked. This issue of household debt service ratio. In a previous life as a columnist, I think it was 2005, in The Guardian, I did an analysis of average household income of young professionals and looked at what I considered then to be the rising cost of property. And I felt in 2005 that professionals were on the edge. 12 years on, what is the view of the banking sector on the level of debt carried by households in Tobago and the extent to which these households can service that debt? And I ask that question because the closer to the edge a household gets in terms of the debt that is being carried, the higher the cost of banking. So those are my two questions.
Thank you, member. So the first question, the extent to which bank fees are cost recovery versus income. When we looked, and it came out very clearly in the independent review that was done, is that it really focuses quite a bit on cost recovery and also the investment in new channels to be able to allow customers to access services with the ease that they want. So what we are seeing is a seismic shift, not unique to the banking industry. We're seeing it in retail, we're seeing it in transportation, you name it. People want to be able to do transactions at their time. And therefore, we have had to invest over the past 4 years, collectively over $900 million just in technology to improve our services, and fraud and all the other things. So that's important, and that came out very clearly in the study. The second area dealing with household debt, I'll ask Nigel to speak on that.
I think if we look at it from the banking sector, the level of household debt right now is quite reasonable and still reasonable. And in fact, the household debt servicing ratio is not what has prevented some of the younger professionals from being able to access mortgages. The main impediment has been the down payment requirement. Finding that initial lump sum, whether it was a 5% or a 10%, that has been more an impediment than the actual debt servicing ability. But as I said, right now, we think it's still reasonable.
I have a question to ask, if we can backpedal a bit on the unsecured, and we want to get into the fees aspect, which this is really about. You spoke about credit cards forming the bulk of unsecured loans. And they fetch 24%, and that compensates for the risk involved. Is that correct? The higher interest rates of 24% would compensate for the risk.
Okay, so the credit card debt would not actually account for the bulk of the unsecured debt that the banks have, but it is a sizable component.
It's sizable. But most of these persons who get these unsecured loans are persons who should not be given loans in any event.
Well, as I said in responding to the earlier question, I mean, it is the debt servicing is still quite reasonable in the households in Trinidad. But just to explain the credit card rate a little bit, the interest rate on the credit card is 24%. That's correct.
That's high.
But it needs to be put in the context, really, of the actual use of credit for credit cards. Because I think most of our clients, including yourselves, I'm sure, would know that with credit cards, you actually have an interest-free period. That if you use your credit card, and in many banks it could be as high as maybe 40 days of free credit. So what we have found really and truly in terms of in the clientele, right, is that the bulk of people actually use the free credit. But the free credit for 40 days, when you aggregate that, is really quite substantial across the system.
Right.
And so the interest rate really on what is left back, okay, is really meant to cover the risk because it is entirely unsecured, and also to recognize the fact that there's a substantial free element of that credit card utilization.
But what that tells me is if most of the customers make use of the 40-day period, as the example you gave, which would be interest-free, then again, the risk, again, is smaller for you, right? That's the first thing. Is that not right? If you are saying the majority take advantage of the 40-day period to not pay the 24%, then again, your risk keeps getting smaller.
One thing, the purpose of a credit card, and it's to provide convenience. So
we understand all that, but we are dealing with fees and risk. And we are trying to ascertain, listen, you are paying less than 1% to persons who put their money in the bank. But you are charging 24% for credit cards. Now, you've given an explanation as to why. And it's to absorb risk and so on. But you are saying most of the people who use credit cards take advantage of the 40-day period so that to avoid the 24%, which means there's very little risk for you because they are paying back on time. Correct?
But by inference...
Is that yes or no?
Yes,
right, so
but
then,
by inference, there is no return to the bank for the cash that has been lent on the credit card for that 40-day period because it's paid off before interest is required to be paid.
No return, but no risk for you. Very little risk.
But we have disbursed funds. So when the credit card is used, we have lost the use of that fund from an investment perspective with no return.
Yes, but
because
again,
it's used, it's out of the bank.
But it continues to help you remain, as you say, strong and profitable, and therefore you can only be strong and profitable if your risk portfolio is very small.
No, but I don't understand the profit. Once it's paid off within the 40 days, there is no accretion to the profit of the institution because there's no return.
We understand
but the funds have been used.
Yes, we understand all that. That's not the issue. The issue is, again, it goes to show that there's very little risk from this portion. You make nothing because there's no interest accrued, but there was no risk in any event. The risk is very small because people are paying back.
Well, I think, Mrs. Sage, what the bankers are trying to say, and perhaps this emphasizes the need for financial literacy throughout the country, because if we are having difficulty understanding your terminology, you can imagine your average customer. And I think that you must feel a sense of responsibility to have your customer understand what you are selling to them and what they are buying into. So we take your point that the fact of the matter is when the customer uses a credit card, they essentially use a bank's money. Yes? Now, could we move on a little bit? We had someone do a printout about different kinds of fees that bankers charge. And they did an analysis of the differences in different kinds of fees. Now, perhaps we can look at the issue, perhaps you can explain to us what would determine the setting of those fees, and why are there such huge differences? For example, let's see, a teller deposit or withdrawal fee for Scotiabank is $7, and for FCB it's $1. And for RBC, FCIB, I beg your pardon, for RBC and FCB, there is no cost. How is that determined?
So again, when you take a fee in isolation without the context of what the fee is related to, meaning is it a part of a wider suite of products? What else is the customer suite that the customer has used with the bank? So, for instance, there are some banks that have transactional accounts which allow clients a certain number of free transactions, teller charges, for instance. If they go over that particular number for a month, then the fee may kick in.
Right, that's better. Now, is the customer therefore not still paying something then? Is that what you're saying? Because if a customer has 3 accounts, so we call that, or we refer to that as the suite of services. You see, that's a big term for me. I thought it was only people who traded on the New York Stock Exchange would be talking about suite of services and that kind of thing. But essentially what it means is the collection of accounts that you may have, yes? So if you don't pay for one, the likelihood is that you are paying a general fee for this. Is that what you're saying?
And it all depends on the bank's strategy and what their particular focus is. And that just reinforces the point that each bank does their own price analysis based on what they feel is the strategy for that bank. And each product and suite of products are different. And I think, as I said in my opening statement, what has really come out of all of these questions is the need for us, and I agree with you, to ensure the information is available to customers so they understand how to best utilize this channel, the bank, and its products more efficiently for them. So I can't speak to what each individual bank's strategy is, but I can assure you that each bank provides different services at different costs to customers depending on how they utilize that service.
Is it that the strategy is determined by home office?
When you say home office, you mean
If the bank is owned, or the majority shareholding is owned by another bank located in another territory, would the policy be determined by that other bank as opposed to the local executive?
Again, speaking on behalf of BATT, we are not aware of the individual pricing decisions that individual banks make. We can only speak about the industry as an aggregate.
Perhaps we could turn our attention back to the document that was submitted to us. Ms. Snow, earlier in your submission, you would have been pretty careful to say that fees have not increased annually. However, if we look at the actual document you sent, fees have increased, almost doubled from 2007 to 2017. In fact, on page 15, we have the maintenance fee, at least the revenue collected, I should say, increased from I'm assuming this is $1 billion. There's no, there's no clarification of what this unit is, but it says 8 in 2007. And in 2017, this is maintenance fees, personal savings account. The revenues increased to $15 billion. As it relates to in-branch withdrawal transaction teller fees, in 2007, we have 5, I don't know if that's million TT dollars. And then in 2017, we have 8, I'm assuming again, $1 billion, 2017. So it's doubling. In the last 10 years, fees collected in maintenance fees have doubled. And in the said document, you would have said that banking fees contributed between 7% and 11% of total income earned in the last 10 years. Now, this is maybe you could explain to me, because I don't have all the information and terminology may be different between the documents that are available to the public. But in the said jawalarambaran.com, again, which you have read, it says, service charges now comprise the single largest source of fee income for commercial banks in Trinidad and Tobago. In 2015, banks earned $835 million in service fees, or about 70% of their total fee income. It goes on to say, a decade ago, banks collected $330 million in service charges, which represented just over half their total fee income. So it appears to me there is some variance as to what is this individual who appears to be the former central bank governor and what is stated in your document. Could you perhaps explain to us, the variance that appears to be in these two documents?
For sure. So let's start with page 15, and the amounts that you're referring to are not income, it's the actual charge itself. So and as the chart indicates, it's the high and the low for the 8 commercial banks. And so what it showed for that particular service fee is what the high has moved to and what the low has moved to over the last decade. And the point was, it hasn't moved every year. I think that was the point of the chart, because I think that was one of the questions that were posed to the Banking Association. In terms of your second question on the information that was provided, as I said, I haven't seen it, but I can categorically tell you it's incorrect. As we have said, the fees that the banks earn is between 7 to 11%. That information is available on the central bank's website for all to see, and it can be provided to you and the committee by the central bank. This is all available to them by the information that we all provide the central bank in our monthly submissions to them in our regulatory reports.
Since we are talking about the central bank, I wanted to inquire, what is the Bankers Association's view as a body with respect to central banks' exercise or non-exercise, depending on how you see it, of its powers?
Of its powers in respect to what? Because the central bank has many powers available under the Act.
Regulatory, obviously.
The powers currently with respect to fees and charges, there's nothing in the regulation with respect to fees and charges, but in respect of interest rates, the central bank does send through its monetary policy changes that are reflected in interest rate in prime. The mortgage market reference rate is a policy rate that is under guidance or guideline from the central bank that they calculate, and they release, and the mortgage market reference rate is used by the commercial banking system in pricing mortgages. So the central bank does exercise its authority in respect of those areas under the Act.
That is interesting, because when the governor was here on a previous occasion, he suggested that in effect all that he had been able to effect with respect to your members was moral suasion. He said he used moral suasion. is it that when he sends out these directives, your members are of the view that they may comply or not comply? What is the value as an association of these directives from the governors?
I think the moral
Point of view.
suasion comment would be specifically in connection with fees and charges on the deposits. So that is where the central bank would in fact have regular conversations with the commercial banking system and really ask us to make sure that we continue to look and see the frequency, the levels, etc., that we really don't increase the fees inordinately. And that certainly would have contributed over the years that the banks are very, very slow to actually move any of these fees. And even the slides referred to on page 15 show how it's moved really, as I said, 2 or 3 times over the last 10 years. When it comes to the other areas, as Karen is referring to, insofar as the policy rates are concerned, MMRR or repo or prime, those are not, that is not moral suasion. Okay, those are ones where the banks do follow. And of course, all of the other regulatory requirements, whether it be the capital requirements, etc., that is not moral suasion. The banks do follow.
Thank you. I believe Member Rambarat has a question.
Just following on that, I had asked the central bank governor about the regulatory environment and whether he was satisfied. And we all know that when it comes to services provided to the customer, there's no regulation. Nobody looking after the customer. I read your submission and I noted in it that it was it of course presented your side of the story. There was very little of the customer's side. And I worry about the protection afforded to customers. So the first question is, do you believe that the sector is operating in an environment where the client is not sufficiently protected? That's the first question. The second thing I want to draw your attention to is the results of your customer surveys. And I know that you've reported on various categories in which you've asked customers for feedback. But nothing in there tells me that you've asked your customers for their feedback on your fees. But I'll point to something in the results. I see that the lowest score you've gotten is 55%. And that deals with the waiting time in the bank. And the second lowest score you've gotten is in the category of taking time to understand your customer needs. And it brings me right back to the rationale for banking fees. And my point earlier on, that you yourself say that banking fees include an element of discouraging people from coming into the bank. And my question to you is, as part of discouraging people to not come in the bank, which would minimize your transaction costs and boost your profits, part of discouraging people from coming into the bank includes not putting sufficient CSRs at the counter so that the lines are long, not having sufficient people to interface with customers and to answer questions, and not providing quality of service that encourages people to walk into the bank. Because I'm very concerned, I come from a rural community. I myself, having adopted almost every part of my life to the technology, I still refuse, and I worked with an international bank, as you know. I steadfastly refuse to do online banking because I particularly enjoy going into the bank. And when I am in Rio Claro and Mayaro, because nobody has brought a bank to Beach or Guayabari, I see most of the population going into the bank. And I feel that part of your incentivizing, or discouraging includes not making banks particularly customer-friendly at branches. And I wonder, in the absence of regulation, in the absence of a robust system of complaints, in the absence of, and I use the model of the Canadian system of the FCAC, where banks are required by strong oversight to deal with customer complaints. And where the balance is struck by the regulation and the regulatory environment between the banks and the customer, that the balance is too heavily weighted in favor of banks, and banks operate in a manner which for over time has been against customer welfare. And that is the second and third objective of this inquiry.
And that really goes to the heart of why we're all here. Without a customer, there is no bank. And I think protecting the customer and ensuring that their deposits and they get the advice that they need is the most important thing that we all think about every single day. So I support your comments and support what you have said. The question around, whether we're trying to disincentivize people from coming into the bank, that's not the case. What we have seen, and this is not something that's only going on here in Trinidad, it's going on around the world. As you said, you've worked in banks outside of Trinidad, and it's affecting the industry in tremendous ways. Banking is no different than what's happening in retail, etc. And what we are seeing is that our customers are coming to us and saying, look, we don't want to spend time in traffic. We don't want to have to drive to a branch. We need you to provide us services in the ways that we want it. And we're having to invest to cater to that customer segment. A millennial has no interest in going into a branch, and we have to also think of that population. But then there are also the existing population of customers who, as you said, enjoy coming into the branch and want to interact with their tellers. And we have ensured that there are services available for them. Do we get it always right? Do we not make mistakes? We are dealing with human beings. The 7,400 people that work in our organization are committed every single day to trying to make sure that we get it right. Can we improve? Can we provide better services? That is what we are doing and working on every single day. But I don't want any customer and the public to leave this JSC by thinking we're trying to push anybody out of our banking halls. We are trying to cater to a seismic change that technology is bringing to the banking industry. Your phone will be your credit card, will be your advice option very soon. And that is something that we can't fall behind in Trinidad and Tobago, or we risk the entire future viability of the banking sector here.
Thank you, Ms. Schnoor. Could you?
Oh, thank you very much. Now, having heard that, the dehumanizing, if I may call it that, it's important really to prepare for the future, and as you say, but we need to deal with the present. Has there been any layoffs in the banking industry of its employees in the recent past?
When we did our study over the last 10 years, the staffing complement across the industry has increased. And a number of our members are actually expanding their operations, not only here in Trinidad, but as you know, branching out to other islands within the region. So I think the great thing about the commercial banking sector in Trinidad is that it's strong, it's growing, and it has continued to employ a significant percentage of people. And what we have seen over the last decade is that that has increased.
So I didn't quite get that clear, Chair. So there's been no layoffs
again, we can only speak to the aggregate data that we have, which shows over the last decade, the number of employees in the industry has increased from, I think, a little over 6,500 to now 7,400.
So it means to say that some of your members may have laid off and some may not. That's what it boils down to. The Vice Chairman has a question to clarify a matter that he had raised earlier.
Well, you said on page 15, the maintenance fees, that particular graph, that's, to me, it looks as if between 2007 and 2017, right, the maintenance fees have generally doubled. Is that a fair assessment of this graphic?
No. What it shows is that the bank, maybe one bank, that's a high. So there between that bar, between $15 and $1, represents all 8 banks. And each bank may fall at different points.
All right, but maybe I should ask a more direct question. What has been the rate of increase in banking fees in the last 10 years of your members?
I mean, again, as we showed on the page, the increases are largely related to volume, new services that were provided, new ATMs, new access credit cards. So when you look at it in aggregate, yes, fees have increased, but so have and when I say fees, meaning the revenue or the
No, I'm just asking
fees.
a simple question. If I were to put a basket of these fees into a basket, what is the weighted average of increase in the last 10 years? Do you have that?
Don't have that in, and as I said in my opening statement, some fees have not increased.
Wait.
over the last
I'm
10
asking
years.
a weighted average. I'm sure you could
We don't have that
disaggregate it.
information.
But let me ask you a question. You say that fees are determined by increasing operating costs, market conditions and competition, improve efficiencies, customer feedback. Now that's very important because the customers, at least the public, seems to represent at least in the last 10 years 50% of all. That's the common man, yes? But it appears to me as a member of the public that when I go into the bank in the last 10 years, despite my feedback, and I do give a lot of feedback, there has really been no improvement or the decrease in prices. In fact, they seem always to go up. And you speak here about the reasons that why that may be, and you speak that it's an increased ATM machine and capital outlay and increase in employment, but you speak nothing about improved efficiencies from this capital outlay. Is it that you spend all this money and then you get no efficiency and therefore you can't pass it back on to the customers? Perhaps you could explain that to us.
But we have passed it on back to the customer. 10 years ago, you couldn't get on your phone and do a transaction. That is now free. You can transfer money, you can pay your bills, you can transfer money to another bank, free. All of those things didn't exist before. That is what our capital investment has gone into because that is what our customers are telling us they want. So we have provided new options, new services to our customers that didn't exist a decade ago. So I'm surprised you haven't seen
but absent of a weighted
benefited.
average, we can't tell for sure.
I would happily welcome you into any one of our branches and I will personally show you how to access those benefits.
Okay, we have to, actually we were supposed to have ended at 10:45 because some of our members have a very important meeting at 11 o'clock today. And I'm so disappointed because I think we are now getting to the point where you are providing us with tremendous assistance by articulating explanations in a way that the average person can understand about what you do and what they can find when they enter into a bank. But before we go, I suspect that people listening will want to hear Forex used in one question at least in this session. So will you indulge me and just give me a quick answer to this? What is the formula and criteria used to distribute Forex to customers, and who dictates how much a customer gets?
It always had to be the trick question to come at the very end. There is, strictly speaking, no formula that is used to determine how the forex that is made available to the banking system is distributed. But in terms of who determines it, to a large extent, it is decentralized with the various account managers and the branch managers. I mean, at the global level, we would receive the foreign exchange that is allocated either from the central bank or that is purchased from our clients. And then we would try to see to what extent we could, in fact, keep everybody somewhat satisfied. You know, the reality that we end up with no one being satisfied because no one gets really the amount that they actually needed. But we try to spread it out as much as possible. There is some consideration that is given on occasion to the size of the long outstanding payables, which is the amount that are owed, let's say, to foreign suppliers. There is some consideration that is given to the purpose behind the transaction, but there's no formula that is actually employed.
So there is no prioritization, let's say, for health and education? No?
Not beyond the consideration that I made reference to.
Okay, I think you have given us a lot of information which we will have to digest, analyze, and so on. And I suspect we may have to prevail upon the association to return on another date when it's mutually convenient. I hope you will not object to that, because I think what you have given us today has been a tremendous amount of quality information that the citizens of Trinidad and Tobago can use and benefit from. So normally at this point we have closing remarks, but again, because of the time constraint on another parliamentary meeting, I have to thank the president of the association and all the very high-powered members and the executive members who came out to assist us with providing information to the citizens of Trinidad and Tobago. I want to thank the media and the persons in the public gallery for attending, and the viewing and listening audience. Thank you all very much.